What's up everybody, Gen X Dividend Investor here. In this video I explain the pros and cons of getting a loan to invest in dividend stocks. But I should caveat this to say that I've never actually taken on debt to buy stocks, so my perspective is somewhat biased. Leave me a comment and tell me if you've ever taken out a loan specifically to buy stocks, or if not, have you seriously considered it? Now the idea for doing this video came from a recent conversation that folks were having on my free dividend Discord. It started when someone named Triple Legacy posted a comment in a channel dedicated to new investor questions, where he asked, "I know everyone says don't go into debt to invest into the stock market, but can you tell me why, outside of not being responsible to pay it all back and picking the wrong stocks? Also, if the only debt I will have is this, then why shouldn't I?" He continued on saying he'd only invest in Dividend Kings and other well-known companies, and he listed Northwest Natural Gas, a utility dividend king, and then Lowe's, another dividend king, Procter & Gamble, yet another king and one I'm long in, Caterpillar, an aristocrat I'm long in, and American States Water, another king. This month, American States Water announced an 8.3% dividend increase, and that allowed them to become the first company in the world to hit 7 decades of consecutive annual dividend increases, at least as far as I know. And then I found a few other companies in the 6 to 7 decade range, including Procter & Gamble, Dover, Nordson, Lancaster Colony, Coca-Cola, Cincinnati Financial, J&J, Kenvue, Colgate-Palmolive, Emerson Electric, Genuine Parts, and Parker Hannifin. Triple Legacy also said that he wants to invest in J&J, a king like I just mentioned, and in Apple, which only has 13 consecutive years but is still a great company, and in Microsoft, which will probably announce their 20th consecutive year of dividend increases next month, and in Outtro, a king, and in Coca-Cola, a king like I previously mentioned, in McDonald's, an aristocrat well on its way to becoming a king, and in Pepsi, a king. He continued on saying that if he bought all those stocks, then he'd be getting dividends 3 to 4 times every month to help pay down his debt. He said he'd never try to sell those stocks as he'd want his snowball to keep going. Triple Legacy finished things off by sharing he was 34 and that he owns his house and his cars and has only a $12,000 home equity loan debt to his name. He also has a couple friends who are paying him rent every month, and he's thinking of putting some tiny houses on his land, probably to gain even more rent. So first of all, congrats for being at a great spot with your finances, as well as for actively trying to enhance your financial literacy by watching videos and such. It's rare to see people do all that, especially at your age. Anyway, the Discord conversation he started continued with people sharing their thoughts on what he said, and then a Patreon aristocrat of mine named Mongo Joe suggested that I make a video about the topic, so here you go. My personal recommendation is that I'd never borrow money to invest in stocks. I've been investing in dividend stocks for over 3 decades now, but I still want to take the risk of using debt to buy stocks. But I'm pretty risk averse, and I make financial mistakes sometimes, so just because I don't do something doesn't mean you can't. I mean, it clearly has some potential rewards for gassing your income, but it also has some significant risks that you need to be aware of. If you're set on doing it, then at least make sure that the interest rate on your loan is low enough such that the yield you're getting from safe dividend stocks makes your return on investment worth the risk. And many of those dividend stocks called out would probably have a much lower dividend yield than what your loans would be. Like Lowe's is at a 1.8% dividend yield right now, Coca-Cola is at a 2.8%. PG is at a 2.4%, and Apple and Microsoft are both under 1%, though I'm guessing their long-term price appreciation will make them compelling investments still. Now, maybe Triple Legacy has a loan source that has a super low rate, and maybe he's going to mix in his quality tickers with some income ETFs, or he's going to do options on them or whatever, in order to help make sure that his divvies could pay back the loan. Let's do an example to see how this could play out. First, let's check out some companies offering personal loans, ranked according to NerdWallet. So they have SoFi showing you can get loans from $5,000 to $100,000 with estimated APRs of about 9% to 30%, depending on your credit rating and your ability to pay it back and such. Glancing through the list of offerings, it looks like 7% is the best rate you can get. Let's pretend he took on a $50,000 loan at a fixed 7% APR, and looking at some of the loan websites, it looks like there are no additional fees are taken out, so the APR they list includes their fee, and most seem to not have prepayment penalties. Most personal loans have durations of 1 to 7 years, but you can find some that go for a bit longer. I'll assume he pays back his loan monthly, and this loan calculator says he'd owe $755 a month for 84 months, so he'd be paying back about $9,000 a year, and over that entire time he'd have to pay back around $13,000 in interest. Let's pretend he invested that $50,000 loan into 5 tickers, so $10,000 into each. Now, I'd personally not feel comfortable only having 5 tickers, unless they were all ETFs, but I'm just doing a simple example. I went with Northwest Natural at a 4.86% yield, J&J at 3%, Outtro at 7.7%, and then I added in 2 tickers he didn't mention to help gas his income, and I picked JEPQ, a covered call type income ETF at around 9% yield, and Devo at 4.5%. That came to an average weighted dividend yield of 5.6% per ticker, and it would generate $2,929 per year or $244 per month, assuming no cuts. Already we run into problems because we just saw he has to pay back about $750 a month, so he's around $500 per month short, and I'm not dealing with taxes yet. So let's say he starts selling some of the stocks to make up the difference. Obviously, he could focus on even higher yield stuff, but I'm trying to utilize some of the tickers he mentioned along with already using some high yield stuff. I have a tool in my spreadsheet called the Living on a Portfolio Simulator, which attempts to model how a dividend portfolio that you were needing to live on would burn down over time if your expenses were more than the portfolio was generating. So in this case, I put in a starting portfolio size of $50K, along with an average weighted dividend CAGR of 2.59%, which is what I calculated the example portfolio would be at, and I started with a 5.86% yield, and I assumed 0% in taxes. I also put in an annual share price increase of 5%, which is lower than the historical market average, but I doubt these tickers would appreciate as much as the market. I'm probably being too generous here even. I then put in that he was $6,000 a year that he was selling off his portfolio, i.e. the $500 a month that he was short to pay back the loan. Again, this is just a fast, quick estimate. It's not accurate nor precise, but I'm just trying to get a feel for things. In 7 years, this estimates that he would end at a portfolio value of $43K. Basically what's happening is that between dividends coming in and some stock appreciation, he could make it, and he'd actually still have lots of his portfolio left. But those are a lot of big ifs. I mean, if the market crashed and went sideways for a few years, then his portfolio would go down faster, potentially to zero before you pay back the loan. Plus, some of those aren't qualified divvies, making your taxes even worse, which I'm not even modeling here. Also note that some of those tickers pay quarterly and some pay monthly, but I'm just doing some quick estimates, but you'd have to factor that into things as well. Again, just a super high level estimate and not one you'd want to make financial decisions based off of. One thing you have to think about is if your dividend payments fall for some reason, then do you have a backup plan to pay your loans? Plus, I wouldn't ignore non-dividend stocks if you're young, though obviously you're suggesting a dividend strategy, and I'd also encourage people to buy when a company is cheap, and many of the stocks you called out look to be quite expensive to me. So instead of all that, my advice is to invest with a mindset that you plan to get rich slowly, and that you'll manage your finances carefully. People who try to get rich quicker with stocks usually get poor quicker. Sure, you can find folks who gamble and take lots of risks and end up doing well in the market, but they tend to be the exception, not the rule. But hey, there are some benefits that I should call out that can come from taking a loan to buy stocks. Like one pro is that you can gain some leverage. What I mean is that using a loan obviously allows you to invest more than you could with just your own capital, potentially amplifying returns if the investments perform well. Of course, that also means that there are larger risks you're taking on, which get exacerbated if the investment doesn't perform as you expect. Another pro is that dividend stocks can provide regular income through dividends, which could help in servicing the loan payments. Plus, if chosen carefully, dividend stocks can offer both income and capital appreciation, potentially outpacing the interest rate on the loan, along with maybe faster growth than inflation. An obvious con are your interest costs to pay on the loan. That interest reduces your net returns, and if the overall dividend yield is lower than the interest rate, modified by your tax situation, then your finances might not end up like you planned. And another potential con is market fluctuations. I mean, stock prices will go up and down, and there's obviously no guarantee that the value of your investments will increase. And while your dividend strategy might insulate you somewhat from market drops, if you get into a point where you gotta sell stocks to cover your loan, then things might not play out as you hoped. Another con to consider is the fact that taking on debt increases your overall financial obligations. Plus, the reality is that any stock can flounder, even dividend kings. Companies can reduce or eliminate dividends, especially in times of financial difficulty, which could reduce the income you rely on to service the loan. This year we saw Leggett & Platt cut their dividend, and they were a dividend king which had 52 consecutive years of dividend increases. Another company that lost their king status this year was 3M, who had over 60 consecutive years of dividend increases. And then last year we saw how another dividend king in VF Corp, the owner of the North Face and Vans brands, cut its dividend. And if you look further back in time, we can find a slew of companies that lost their dividend king status for a variety of reasons, including Winn-Dixie, Aon, Integris Energy Group, Masco, and Diebold. The point is that any company can cut their dividend and even end up bankrupt, all of which could hurt a strategy to take on loans to invest for dividends. And don't forget the Enrons and the Lehman Brothers and the other big companies that at one time seemed bulletproof. Okay, and another con to be aware of is margin call risk, assuming you get a margin loan, because if you're using a margin loan, then a decline in stock value could trigger a margin call, forcing you to sell assets at a loss to cover the loan. Another con to consider is the psychological stress you'll probably take on. I mean, the pressure of repaying a loan can add significant stress, especially if investments are underperforming. You also may face liquidity risk. Like if you need to sell investments for any reason to repay the loan, you might have to do so at an inopportune time, potentially locking in losses. Of course, the ideal situation is that you can cover all your loan payments via your divvies, and maybe even make more divvy income than the loan payments, so that you actually start getting extra income along the way, and you're slowly paying off your loans and building principal, all on someone else's dime. But again, don't forget about the whole aspect of taxes potentially eating into things, which could then cause you to need to get even more yield from your divvies, further ramping up the risk. And don't forget that the interest you pay on your debt is unlikely to be tax deductible. Another potential con is that if you struggle to pay back your loan, then your credit score is probably going to get negatively impacted. So overall, using a loan to invest in dividend stocks can be profitable if the stocks perform well and the dividends and capital gains exceed the interest and other costs. But doing that introduces a variety of risks to be aware of, especially if your dividend stocks don't perform as you need. Now, a related question is, should you invest in stocks if you have debt already? And that depends on a bunch of factors, including the type of debt you have, the interest rates, your financial goals, and your risk tolerance. So like if you have high interest debt, like credit card debt, which can often be in the 15 to 25% APR range, then it's generally advisable to focus on paying that off before investing. The guaranteed return from paying off high interest debt is typically greater than the potential returns from investing in stocks. That reminds me of a blurb I read on Quora where this guy goes, and I quote, "I used to work in the business of processing credit card payments, and I can tell you that hands down, the best investment available to most people is paying down high interest credit card debt. I've seen thousands of credit card statements where people were paying the minimum payment or less, digging themselves in deeper and deeper. Summon all your discipline to pay this off as quick as you can, even if it means eating beans and rice, taking in a roommate, skipping vacations, concerts, and driving a beater car. This kind of debt is a stone around your neck and will drag you down. It makes little sense to invest in a CD at 5% while paying 15% on a hefty credit card balance. Same goes for any car loans or personal loans that have interest rates that are higher than the interest rate on your mortgage, money market account, or 401k. And while you're paying down your high interest debt, think of ways of investing in yourself by learning practical skills and keeping yourself fit and healthy." End quote. All of that is sage advice in my opinion. Of course, once you've paid off your high interest rate debt, then I'd definitely push towards investing in good stocks. Most people never start investing, so even investing some money puts you ahead of the curve. And once you start, you should continue on for the rest of your life, kind of like you should eat healthier and work out for the rest of your life as well. Now, you also might want to first build up a 3 to 6 month or more cash position in an emergency fund before you invest too much, but that's something you gotta gauge for your life realities. Like if you have a family or have health issues or whatever, then having more cash than a healthy single 21-year-old probably makes sense. But still, try to start investing as soon as you can. One of the hardest things when establishing a new habit is to start, and the next hardest thing is to sustain doing it. And definitely prioritize getting rid of nasty debt. Everything depends on your risk tolerances and your goals and needs. If you have goals you want to achieve within the next few years, like buying a house or something, then you might want to focus on paying down debt and saving rather than investing in stocks. If you have some longer-term goals like retirement and your debt is manageable, then investing in stocks could make sense, as stocks generally offer higher returns over the long term. You could also do a hybrid approach of paying down some debt, investing some, saving some, etc. And again, really be aware of how your actions are impacted by taxes. Like some investments offer tax advantages, they can make them more attractive. For example, contributing to a 401k with employer matching is often considered free money and can be a smart move, even if you're carrying some debt. Taxes are often quite foreign to many folks, and yet the number one expense you'll probably pay in life is taxes, even more than what you might spend on your kids. So I'd encourage you to level up your tax knowledge. Many wealthy people become quite good at minimizing their taxes, and in fact some of them do indeed use debt to avoid having to pay tons in taxes. Specifically, they use their massive stockpile as collateral for loans, which they then use to pay their bills, and since you generally don't pay taxes on loans, then as long as you can keep taking on bigger loans to pay expenses plus any interest on their loans, then they can continue to defer actually paying taxes. They can just keep borrowing more money against their stocks rather than sell them, because selling triggers capital gains, which usually leads to taxes and taxable accounts. I guess they gotta hope that their stocks don't crash and that the banks or whomever they're borrowing from keep accepting their stock as collateral, but it's pretty crazy to think of. There are lots of fascinating loopholes the wealthy can exploit and capitalize on, and leave me a comment if you want me to do a video on taxes. Now, a question some people might be wondering is what types of loans can be taken out in order to invest in stocks? There are personal loans, home equity loans or home equity lines of credit, margin loans from brokers, etc., and each loan can come with its own unique features, interest rates, and eligibility criteria. Definitely research and compare different loan options to find one that is most suitable for your investment needs and financial realities. Again, I don't recommend borrowing to invest in stocks because you gotta realize that having to pay down debt is something that you're guaranteed to have to do, whereas getting any returns from your investments aren't guaranteed. And you'll no doubt hear stories of people who borrowed high interest rate loans, sometimes even on their credit cards, and they ended up starting a business or even gambling successfully in the market. But my advice is to not get lured into a risky financial situation where you just gotta hope for the best. Hope isn't a strategy. Focus on getting rich slowly, not quickly, and I'm confident most people will do better that way in the long run. You can become wealthy if you're willing to take the long, hard path, step by step, dollar by dollar. Even if you can get a loan from a source you trust, like your parents, I'd still be careful. I had a relative who royally screwed me out of $150K because I trusted him enough to not sign anything on paper. That was a big financial mistake I made. Anyway, while I wouldn't take out a loan to buy stocks, I have and would encourage carefully taking out loans for a mortgage for a home. I say carefully because I've witnessed people who took on too large of a mortgage and they became house poor and even house bankrupt. So be conservative, and always read the fine print on your loans. You want to know things like if they have the right to raise your interest rates or something else. Maybe even force you to suddenly pay off your loan, or maybe they don't let you do that. Just be aware. Plus, government legislation could happen that could negatively impact your loan or investment in ways you never thought of, so try to leave yourself some wiggle room in things rather than do the most you can handle at the time. Don't assume best case conditions will always happen, but also don't always assume the worst. I heard a Joe Rogan podcast where he was talking to the psychologist type who was explaining how bad it is for your health to constantly ruminate about your problems. They said that the number one symptom of depression comes from having a pathological obsession over your trials and tribulations and pains. Constantly talking about and thinking about and complaining about the tough things in your life is a bad habit which tears your body and psyche apart. And if you find yourself doing that, then stop and do stuff that is good for your health. Get out of the house and do things. Run an errand. Walk. Action is often a cure for many things that ail you, so definitely don't sit there and stew about all the crap that is going wrong or could go wrong in your life. Take charge and deal with things. Tackle what's ever wrong, don't put it off. Heck, the whole concept of taking on debt to invest in stocks reminds me of people who are doing that new thing of buy now and pay later. Sure, you get short-term and immediate satisfaction at the cost of a debt anchor that is added to your neck. There's a reason why financial guru Dave Ramsey is so big on getting out of debt. As Ramsey sees it, America's debt crisis is an epidemic akin to drug addiction, and its roots lie in individual behavior. The only way to escape its crushing weight is to stop enabling yourself and go cold turkey. Live on rice and beans, get a second job, sell your money-sucking car, etc. Ramsey says that if you're working on paying off debt, the only time you should see the inside of a restaurant is if you're working there. And why is Mr. Ramsey so against taking on debt? Well, there was a time when he borrowed so much that he eventually couldn't pay it back, and he had to declare bankruptcy. That was his wake-up call to go on a debt-free path. So now I'd like to ask you a question. If you had to take on a 5% loan to invest in one ticker, then which ticker would that be? And with that, I would say that if you got any value from this video, then I would really appreciate it if you hit the thumbs up button, subscribe if you haven't yet, and click that bell notification, as all of that really helps my videos. Now I'd like to shout out DB Stocks, who just signed up as a Patreon aristocrat. Plus, I'll recommend that everyone check out my FASTgraphs affiliate link along with my coupon code in the description of this video, as using both will allow new users to get 25% off their first payment, even if they sign up for a full year. I'll also recommend that you check out my Seeking Alpha affiliate link, as new users can often get good discounts for signing up. Plus, take a look at my Patreon seats to see if there's any you want to sign up for, but since my Patreon Aristocrat and King seats are usually sold out, I'll also recommend that you join my channel membership, which gives you a variety of perks I think you'd like. And don't forget to join my free Dividend Discord chat server, which has over 11,000 Dividend investors on it from 83 countries around the world. Thanks for watching, stay positive, and I'll talk to you again real soon. Remember, I'm not a financial advisor, and my videos are for entertainment and inspirational purposes only. Investing of any kind involves risk. I'm only sharing my opinions with no guarantee of gains or losses on investments.